Okay, let's unpack this. Have you ever felt like the world of corporate responsibility, environmental impact, and social governance is, well, it's a rapidly evolving landscape, isn't it?
Oh, absolutely.
And keeping up feels like a full-time job,
Yeah.
especially when you need to really master it for an exam. It's just such a vast ocean of information sometimes.
Indeed. And for you, the learner, that challenge is amplified. You don't just need to understand, you need to deeply internalize these concepts.
Right. And apply them.
Exactly, apply them. So today we're doing a comprehensive deep dive, and it's designed specifically with that exam focus in mind.
Okay.
Our mission, really, is to distill the core concepts, sustainable development, ESG, assurance, using the exact language and terminology you'll find in your materials.
Ah, so it'll sound familiar. That's helpful.
Precisely. We'll make sure you not only grasp what these concepts are, but also how they apply, in real-world scenarios, and crucially, how you might see them in those exam-style questions.
Good, good. That practical angle is key.
We want to help you deeply understand and, importantly, retain the material for when you need it most.
Okay, sounds like a plan. So we'll navigate this whole intricate journey, right? From those big global sustainability goals all the way down to the nitty-gritty of, say, the Indian reporting frameworks.
That's the plan. We'll look at how companies actually weave these principles into their everyday operations.
Okay.
And we'll even uncover the role of auditors, which is becoming, well, increasingly critical in this new era of non-financial reporting.
Yeah, that assurance piece is vital. Hopefully by the end, you, our listener, should feel much more confident, ready to apply this knowledge.
That's the goal.
So let's begin by laying the groundwork. At the heart of pretty much everything we're discussing today is this powerful, but often, let's face it, broadly defined concept: sustainable development. It's a phrase that's everywhere, but what does it really mean when you strip away the jargon, especially for exam purposes?
It really is more than just a buzzword. And yeah, for your exam, getting the definition right is key. The foundational concept, it comes from the landmark Brundtland report.
Okay, Brundtland, got it.
And it defines sustainable development precisely as development that meets the needs of the present.
Without compromising the ability of future generations to meet their own needs.
Yeah.
Yeah, that's the classic definition.
That's the one. And it's absolutely crucial because it highlights an immediate fundamental truth. The environment is an exhaustible resource.
Right. It's not infinite.
It's not. And this isn't just about, protecting nature for its own sake, though that's important too. It's recognizing our current prosperity relies on finite resources.
So we have to be careful.
We have to use them rationally, protect them for the good of the earth, humanity, all living things. It's about finding that balance, making sure our progress today doesn't come at an unbearable cost for those who come after us.
Yeah.
And this core principle, this balance, it directly guides how government should operate and make those big long-term decisions.
That makes perfect sense. So this grand idea, sustainable development, how does it translate into something, well, actionable for a business? How do companies take that philosophy and actually put it into practice?
Well, that's where the ESG framework comes in. That big concept, sustainable development, finds its practical application in the business world through ESG.
Environment, social, and governance.
Exactly. E, S, and G. It gives companies a structured way to measure, manage, and importantly, report on their impact and performance beyond just the financials.
Okay.
And each pillar, E, S, and G, addresses a really distinct dimension of a company's impact.
Right.
So first, you've got the environment E pillar. This covers things like corporate climate policies, energy use, waste, pollutions, natural resource conservation, and treatment of animals.
All the green stuff, basically.
Well, yeah, but think about it practically. A company uses natural resources, right? Coal, electricity, water for its operations. Exactly. And this pillar asks, what wastes are left behind? Carbon emissions, water discharges, e-waste. It highlights that dependence on the environment and the impact, positive or negative.
Are they efficient? Are they polluting? Are they looking at renewables?
Precisely. All those questions fall under E. Then next, the social S pillar. This addresses the relationships the entity has and the reputation it fosters with people and institutions in the communities where you do business and the value chain involved.
So people-focused.
Very much. It goes beyond just employees, though things like labor relations, diversity, and inclusions are vital.
Okay.
But it's also, how does the company interact with its customers, its suppliers, the broader community?
Right.
The core idea is simple. Every company operates within a broader and diverse society. And its interactions within that society, Well, they're paramount for its long-term survival, its reputation, its social license to operate, really.
Got it. And the third one, governance.
Finally, yes, governance, G. This refers to the internal system of practices, controls, and procedures entity adopts.
Okay.
In order to govern itself, make effective investment decisions, comply with the law, and meet the needs of all stakeholders.
So this is the how the company is actually run.
Exactly, the how. It emphasizes that every entity, because it's a legal creation, fundamentally requires governance.
Right. To keep it on the straight and narrow.
To ensure it operates ethically, efficiently, lawfully, and importantly, serving the interests of all parties involved, shareholders, employees, the community. Strong governance really underpins how effective the E&S initiatives can be.
That's a really clear breakdown of the 3 core pillars. But I know from, looking at this material, ESG isn't just about these broad categories. It gets incredibly granular, doesn't it?
Oh, absolutely.
Can you give us a sense of just how broad and detailed these areas can be, especially for someone listening who might be preparing for an exam where, specific elements might get tested?
Absolutely. The breadth is significant, and understanding the specific elements under each pillar is crucial. That level of detail is exactly what you might see in a case study or specific question.
Okay, let's hear them.
Right. So under the environmental pillar, we drill down into specifics like climate change. And this isn't just one thing. It covers metrics like carbon emissions, product carbon footprints, the emissions across a product's whole life.
Cradle to grave.
Precisely. How a company's financing impacts the environment and its climate change vulnerability, how exposed it is. Natural resources. This looks at critical inputs, things like water stress, biodiversity and land use, raw material sourcing.
Okay.
Pollution and waste. This includes toxic emissions and waste, packing material and waste, and that growing concern, e-waste. And importantly, environmental opportunity. This flips it around. It highlights proactive stuff like clean tech, green building, renewable energy investments.
So risks and opportunities within E.
Exactly. Then for the social S pillar, the elements are just as detailed. Human capital. Big area. Focuses on labor management, fair practices, wages, health and safety, human capital development training, education and supply chain labor standards, making sure the whole chain is ethical. Product liability. This covers product safety and quality, chemical safety, financial product safety for banks, etc. Privacy and data security, huge now, and responsible investment. Stakeholders' opposition. This specifically addresses issues like controversial sourcing, and conflict minerals, that kind of thing, and social opportunity. Again, the positive side, providing access to communication, finance, healthcare, or creating opportunities in nutrition and health.
Okay, lots under S&G.
And for governance, G, we consider corporate governance itself. Things like board diversity, executive pay, ownership structures, robust accounting practices.
Traditional stuff.
Some traditional, some newer focuses like diversity, but also corporate behavior. This covers business ethics, anti-competitive practices, preventing corruption and instability, contributing to financial system stability, and increasingly, tax transparency.
Wow. That really does showcase the immense detail involved. It makes it clear that, as the material says, ESG reporting is all about disclosure of information, data, metrics that explain the added value in these 3 areas.
Exactly. It's not just broad statements.
No. And importantly, this disclosure can be both quantitative and qualitative. It's not just numbers.
Right. The narrative matters, too.
And that mixed approach, combining both, surely adds maximum value because you get the hard data and the story behind it. It paints the full picture.
Precisely. It gives context to the numbers.
So we've established sustainable development and the ESG framework, but how do these concepts scale up, to a global level? What's the overarching framework that tries to bring nations and companies together around these big ideas?
Well, that's where the Sustainable Development Goals, or SDGs, come into play.
Okay, the SDGs.
Yeah. Building on that idea of sustainable development, back in 2015, sustainable development was adopted by all United Nations member states to provide this crucial global blueprint. These are the Sustainable Development Goals, SDGs.
Right. The 17 goals.
Has 17 goals. And they represent, well, an urgent call for action by all countries developing everyone. Their purpose is incredibly ambitious, and it's all interconnected. addressing global challenges like poverty, protecting the planet, improving lives, spurring economic growth,
All at the same time.
all while tackling climate change, preserving oceans and forests, promoting peace and justice. It's a really comprehensive global agenda. It recognizes you can't solve these issues in silos.
Can you quickly list them out just so our listener can grasp the sheer scope? It's quite something.
Of course. It's worth hearing them all to see how comprehensive it is. The 17 SDGs are: 1. No poverty. 2. Zero hunger. 3. Good health and well-being. 4. Quality education. 5. Gender equality. 6. Clean water and sanitization. 7. Affordable and clean energy. 8. Decent work and economic growth. 9. Industry, innovation, and infrastructure. 10. Reduced inequalities. 11. Sustainable cities and communities. 12. Responsible consumption and production. 13. Climate action. 14. Life below water. 15. Life on land. 16. Peace, justice, and strong institutions. 17. And finally, number 17, partnership for the goals.
Phew, it really covers everything.
It does. And what's really insightful, especially when you study them, is how interconnected they are. They are isolated objectives.
Right.
Achieving no poverty, for instance, often hinges on quality education and decent work. They require this holistic approach, recognizing that progress in one area often supports progress elsewhere.
And it's not just a set of ideals on paper, is it? There's actual UN machinery behind this.
Absolutely. The Division for Sustainable Development Goals, the DSDG within the UN, plays a really active role. They provide substantive support, they build capacity for the SDGs, they're actively driving that COM30 agenda forward. It shows a serious, coordinated commitment to try and make these goals a reality.
Okay, so beyond these aspirational goals, how do companies actually report on their sustainability performance? What are the major global frameworks guiding them? It often feels like a bit of an alphabet soup out there with all the different standards.
You're right, the landscape can seem complex, but certain frameworks have definitely gained significant traction and, thankfully, are becoming more standardized.
Good.
It's important to note up front, though, that mandatory reporting requirements are mostly associated with the public sector or government-run companies, large corporations, multinational business conglomerates, and listed companies on stock exchanges.
So the big players mainly.
Primarily, yes. Smaller, unlisted entities might do it voluntarily, but the real pressure is on the larger, public-facing organizations.
Okay, so what are the key frameworks?
All right, let's look at the key global players. The Global Reporting Initiative, GRI, is, well, it's huge. It's the most widely used framework.
That 93% number again.
Exactly. 93% of the world's largest 250 corporations reporting through it. GRI provides standards for reporting on economic, environmental, and social impacts. And its reports are aimed at all stakeholders, investors, employees, communities, everyone. It's very comprehensive.
Okay, GRI is the big one. What else?
Then you have the Carbon Disclosure Project, CDP. This one's more specific. It captures environmental performance data, focusing on GHG emissions, water, forests, and supply chain.
More environmental focus.
Definitely.
Yeah.
And this data is primarily aimed at investors, buyers, other stakeholders who need those critical environmental metrics, especially for assessing climate risk.
Got it.
Then there's the International Integrated Reporting Framework, IRRC. This one focuses on the guiding principles and content elements for integrated reports.
Integrated reports, trying to link financial and non-financial.
Precisely. They aim for that holistic view of value creation, covering the organizational overview, governance structure, business model, risks and opportunities, strategy, performance, outlook, etc. The idea is to connect the dots between financial performance and broader sustainability impacts.
What's fascinating here is it feels like we're seeing a push for these different frameworks to actually work together more now. Is that right? A drive towards a more unified system.
Absolutely. And that pursuit of harmonization is critical. You're spot on. What's particularly insightful and important for context is that back in September 2020, these major institutions, GRI, CDP, IRC, SSB, they committed to working towards a comprehensive corporate reporting system.
Ah, okay, a collaboration.
Yes, the intention was clear. Provide joint market guidance on how these frameworks could be used together, complementarily, and develop a joint vision for how they can complement financial GAAP, generally accepted accounting principles.
Right, like a sustainability gap.
Sort of. To serve as a natural starting point for a more coherent global system,
Yeah.
it was a really powerful move towards greater standardization, less confusion for companies and report users.
And building on that, a new major player emerged relatively recently that seems to be really changing the game. The International Sustainability Standards Board. ISSB.
Yes.
Tell us about its creation and what it aims to achieve. This feels like a really critical piece of the global puzzle now.
It absolutely is. The ISSB is a direct strategic response to a growing, urgent demand from investors.
Okay.
In November 2021, the IFRS Foundation trustees, the same body that oversees international financial reporting standards, announced its creation. Why? To meet that increasing demand from international investors for high-quality, transparent, reliable, and comparable reporting on sustainability.
So like IFRS, but for sustainability.
That's a good way to think about it. Investors already have IFRS to compare companies globally on financials. The ISSB's core intention is to deliver a comprehensive global baseline of sustainability-related disclosure standards, specifically for investors and capital markets.
Okay. Giving them consistent data.
Exactly. Consistent, comparable information about sustainability risks and opportunities so they can make properly informed investment decisions.
And they've already put out some standards, haven't they?
They have. A significant step was in March 2022 when they launched consultations on their first two proposed standards, IFRS S1 on general sustainability disclosures and IFRS S2 climate-related disclosures.
Right, climate being a big focus.
A huge focus. And importantly, IFRS S2 doesn't start from scratch. It intelligently builds upon the recommendations of the Task Force on Climate-Related Financial Disclosures, TCFD.
TCFD, that rings a bell. Financial Stability Board.
That's the one. Created back in 2015 by the Financial Stability Board, FSB, specifically to help companies create consistent climate-related disclosures. It was particularly targeted at financial firms, banks, insurance, recognizing their unique exposure.
Okay. And S2 also uses SSB.
Yes, it incorporates industry-based disclosure requirements derived from the Sustainability Accounting Standards Board, SASB standards, which provides sector-specific metrics.
Makes sense.
And just to complete the picture, another key player was the Climate Disclosure Standards Board, CDSB. They were focused on mainstreaming climate reporting. And it's notable that the ISSB has taken the technical guidance for developing IFRS sustainability disclosure standards from the CDSB. The CDSB has now essentially consolidated its work into the ISSB.
Okay, so things are converging.
They are. And finally, the Value Reporting Foundation, VRF, which itself was a merger of SSB and ISSB, is also actively working with the ISB and ISSB to further build that integrated reporting framework. So it really underscores this collaborative, consolidated effort. It's a massive undertaking, but the goal is a truly coherent global system.
Okay, now that we've laid out these global frameworks, let's try and apply this. Like you might see on your exam. Imagine you've just joined a listed company. It's not huge, not in the top 1,000 by market cap, but they've decided they want to voluntarily include sustainability reporting using the GRI framework.
Okay. Good scenario.
So in that context, first, what is your understanding of sustainability reporting? And second, what are some of the expected benefits for a company like this choosing to do it voluntarily?
Right. This is a classic exam-style question. Tests your core understanding of the what and the why. So first, sustainability reporting. The definition to know is it's an organization's practice of reporting publicly on its economic, environmental, and/or social impacts, and hence its contributions, positive or negative, towards the goal of sustainable development. Essentially, it's a comprehensive mechanism of measuring and disclosing sustainability data with performance indicators and management disclosures.
So it's structured public communication about impact.
Exactly, beyond just the financials. Now, the benefits, especially for a company doing it voluntarily, there are several key ones.
Okay.
First, it helps stakeholders, investors, customers, employees understand the company's performance on sustainability. It builds trust.
Right, transparency.
Transparency. Second, the process itself, preparing the report, forces the company to think about the link between financial and non-financial performance. It encourages a more holistic view internally.
Ah, interesting. An internal benefit, too.
Definitely. Third, and this is huge, it aids in long-term value creation. Why? Because it prompts companies to identify, manage, address ESG issues proactively. And investors today are really looking at ESG factors as material risks and opportunities. They actively seek these disclosures for investment decisions.
So it attracts investors.
It certainly helps. Finally, for the company itself, investing in social and environmental issues improves its own resilience, its business continuity. It also strengthens its position with, say, B2B customers and helps attract new ones. Sustainability performance is becoming a real differentiator in the market.
Builds reputation, makes the business stronger.
Precisely. It's about building a reputation and a more resilient business model for the long haul.
Okay, moving from those specific disclosures, let's look at how companies try to weave this all together into a more holistic picture. This brings us to integrated reporting, which aims for that broader, more cohesive view. It sounds like it's trying to tell the whole story.
That's exactly it. Integrated reporting, at its core, connects financial statements and sustainability-related financial disclosures into one cohesive report.
One document.
Ideally, yes. The overarching aim is to foster high-quality, understandable, enforceable, and globally accepted accounting and sustainability disclosure standards. It's about presenting this unified narrative of how an organization creates value over time. And it does this using various forms of capital, not just financial capital.
Ah, yes, the 6 capitals. This is a key concept in integrated reporting, isn't it?
It is, sometimes called the 6 Cs. These are the resources and relationships an organization uses or affects. Understanding these is crucial for grasping the framework. Let's detail each one, maybe with some practical context.
Good idea.
First, financial capital. This is the traditional one, the pool of funds available to the organization for use in the production of goods or provision of services.
Money, basically. Debt, equity.
Yeah. Debt, equity, grants, cash generated from operations or investments. The financial lifeblood.
Okay.
Next, manufactured capital. This refers to human-created, production-oriented equipment and tools. Think physical stuff.
Buildings, machines.
Exactly. Buildings, machinery, vehicles, even broader infrastructure like roads, ports, waste, or water treatment plants owned by the company. The tangible assets enabling operations.
Got it.
Then, natural capital, defined as an input to the production of goods or the provision of services. And crucially, an organization's activities also impact, positively or negatively, on natural capital.
Right. Resources used and impacts made.
Yes, it includes water, land, minerals and forests, biodiversity, and ecosystem health. The environmental resources a business relies on and affects.
Okay.
Human capital. This is all about the people. People's skills and experience, their capacity and motivations to innovate.
Talent and knowledge.
Talent, knowledge, alignment with the company's values and strategy, their ability to implement strategy, their loyalties, their ability to lead, collaborate, the workforce's capabilities.
Makes sense.
Social and relationship capital. This is about institutions and relationships established within and between each community, group of stakeholders, and other networks to enhance individual and collective well-being. This includes shared values, key relationships with customers, suppliers, partners, the trust and loyalty built, and very importantly, an organization's social license to operate.
Ah, that intangible permission from society.
Exactly. And finally, intellectual capital. This is seen as a key element in an organization's future earning potential. There's a tight link between investment in R&D, innovation, human resources, external relationships, all determining competitive advantage. This includes patents, brands, copyrights, organizational knowledge, software, proprietary processes, the non-physical knowledge assets driving future value.
That's a great overview of the 6. And it's interesting, the material notes that the Asia-Pacific region continues to dominate in presenting sustainability data in annual reports, with about 60% of companies reporting in 2022.
Yeah, that's a significant statistic.
It really shows how rapidly these concepts, especially integrated thinking, are being embraced and reported on, particularly in this part of the world, kind of leading the way.
It certainly suggests a strong uptake in the region.
Okay, let's put these 6 capitals to the test again. Another exam-style scenario, because applying this is where the understanding really clicks. Imagine Trustworthy Industries Limited, a listed company. They're doing integrated reporting and cross-referencing with India's BRSR framework.
Okay, typical setup.
They want to know which capitals are involved in 2 specific activities. First, I increased digital mobile app users from 2 lakh to 4 lakh, and 100% increase in digital collection, benefiting customers and digital operations.
Mm-hmm. And just for our listener, lakh is Indian numbering, meaning 100,000, so 200,000 to 400,000 users.
Right, thanks for that clarification. And the second activity, I increased beneficiaries under flagship CSR programs from 10,000 to 75,000, providing value for communities and sustainable livelihood. Which capitals are primarily involved here? Take a moment, listener, to think about it.
Okay, ready to break them down. This is exactly how you'd approach it in an exam.
Let's do it.
For scenario I, the increase in mobile app users and digital collections. The capital referred to is intellectual capital.
Okay, why intellectual?
The reasoning is clear. It involves use of technology for deriving business benefits. It is invested in innovation deriving business benefits from digitization. The mobile app, the digital collection system, these are products of the company's knowledge, its R&D, its technological advancements. That fits squarely under intellectual capital, driving future earnings and competitive advantage.
Got it. Technology and innovation points to intellectual capital. What about the CSR program?
Right. For scenario 2, the increased beneficiaries under the CSR programs providing value to communities. The capital referred to here is social and relationship capital.
Makes sense. Community-focused.
Exactly. The explanation is increase in number of beneficiaries under flagship CSR programs, providing value for communities and sustainable livelihood is an example of relationships established within and between each community, group of stakeholders, and other networks to enhance individual and collective well-being. This perfectly aligns with social capital's focus on relationships, trust, community well-being, and building that crucial social license to operate.
Yeah, these examples really show how those abstract capitals connect to real business activities and their impact.
Precisely. Linking actions to the different forms of value creation or depletion.
Okay, if we connect this to the bigger picture again, it's clear sustainability and ESG aren't just voluntary anymore in many places. How are different countries actually pushing this forward with regulations? It seems like there's global momentum, but maybe different speeds or approaches.
Indeed, there's strong and, frankly, accelerating global momentum. Various countries are implementing their own regulatory frameworks, often converging around similar principles, but with local nuances.
Okay, like the U.S., what's happening there?
In the United States, a big move was in March 2022, when the SEC proposed specific climate risk disclosure requirements for publicly traded companies.
Ah, the SEC getting involved is significant.
Very significant. These proposals would seriously expand annual reporting requirements, often guided by TCFD recommendations. Companies would need to discuss climate risk management, financial impacts, mitigation strategies, maybe even scenario analysis, transition plans, public climate goals.
Wow, quite detailed.
It's a potential major shift for the U.S. market, pushing for much greater climate transparency.
And the UK, they seem quite advanced on climate targets.
The United Kingdom has been very proactive, yes. They set that legally binding target back in 2019. Net zero greenhouse gas GHG emissions by 2050.
Ambitious.
Very. And the Companies Act of 2006 is key. It was expanded in 2022 to include sustainability matters aligned with TCFD for large companies.
So specific requirements there too.
Yes. On strategy, processes, due diligence regarding environmental impacts, employees, social matters, human rights, anti-corruption, for the environment specifically. Climate risks and opportunities, how they're managed, targets, KPIs, integration into governance, impact on strategy. They also have things like streamlined energy and carbon reporting. And in 2023, they formalized sustainability disclosure requirements, SDRs. So a pretty robust framework.
And the EU, they seem particularly active, maybe even leading the charge. It feels like there's always news coming out of the EU on this.
That's very true. The European Union has a remarkably rapid timeline of legislative developments. They're definitely setting a high bar.
Like what specifically?
Well, just look at the dates. March 2021, the Sustainable Finance Disclosures Regulation, SFDR, took effect. That's about how financial firms disclose sustainability. April 2021, the European Commission adopted the Corporate Sustainability Reporting Directive, CSRD proposal. That's huge. It makes reporting mandatory for a much wider range of companies from 2024.
Wow, 2024 mandatory. That's soon.
It is. Then December 2021, the first rules under the EU taxonomy were published, defining what counts as green economic activity. And February 2022, they adopted a proposal for corporate sustainability, due diligence, focusing on human rights and environmental respect across global value chains.
It really is comprehensive and fast-moving.
Absolutely. It's a rapidly evolving landscape aiming to embed sustainability deep into European business. And even China is moving. In June 2022, they brought in voluntary guidance for enterprise ESG disclosures, signaling a growing focus there too.
This really does show that global momentum towards standardization and increasingly mandatory disclosures, doesn't it?
Without a doubt.
It's clearly shifted from being a nice-to-have or maybe a PR thing
Right.
to being a fundamental part of how businesses are expected to operate and report worldwide. The pressure for transparency and accountability is just undeniable now.
It's a systemic shift.
Now, let's bring it home to India. India has its own unique and frankly quite progressive journey in integrating sustainability. Our ancient texts for centuries have emphasized harmony with nature, welfare for all. I remember reading, "Keep pure, for the earth is our mother, and we are her children."
Beautifully put. And that heritage shows.
With that kind of vision, India is definitely not behind in this global endeavor. Let's trace India's specific path in ESG. It's quite a fascinating evolution, isn't it? From voluntary guidelines to mandatory reporting.
It really is. India's journey has been progressive, blending those traditional values with modern regulatory foresight.
Yeah.
It started picking up steam back in 2009. The Ministry of Corporate Affairs, MCA, issued Corporate Social Responsibility Voluntary Guidelines.
Okay, CSR guidelines first. Voluntary.
Voluntary, yes. Encouraging businesses to integrate sustainability, a foundational step. Then in 2011, MCA followed up with the National Voluntary Guidelines on Social, Environmental, and Economic Responsibilities of Business, NVGs. More specific guidance, still voluntary.
NVGs, okay.
The big shift came in 2012. SEBI, the securities regulator, mandated the top 100 listed companies, by market cap, to file a business responsibility report, BRR.
Ah, BRR, mandatory for the top 100. That's key.
That was the transition point, directly linked to ESG principles. And this expanded further in 2015. The BRR became part of the main listing regulations, the SEBI Listing Obligations and Disclosure Requirements Regulations 2015, or LODAR.
ODAR, and that covered more companies.
It did. It expanded the requirement to the top 500 listed companies. Then in 2017, showing real foresight, SEBI recommended integrated reporting for those top 500 companies.
Recommended, so voluntary IR.
Voluntary IR, yes. Encouraging that holistic view. 2019 was another big year. MCA revised the NVGs, strengthening them into the National Guidelines on Responsible Business Conduct.
NGRBC.
Replacing MVGs.
You're listing and refining, yes. And concurrently, the mandatory BRR reporting was expanded again, now mandatory for the top 1,000 listed companies.
Top 1,000, okay, significant scope increase. And the most recent and arguably most impactful development was in 2021. SEBI introduced the new reporting requirements on ESG parameters called the Business Responsibility and Sustainability Report.
Yeah.
BRSR.
BRSR, replacing the BRR.
Exactly. The BRSR builds directly on those NGRBC principles and mandates much more quantitative and standardized disclosures. It really positions India as a leader in comprehensive, mandatory ESG reporting.
It's quite a journey, and it's not just the regulators pushing this, is it? Professional bodies like the Institute of Chartered Accountants of India, ICII, they've been incredibly proactive too.
Oh, absolutely. ICI has been instrumental. Recognizing the shift, they've taken crucial steps to lead the profession.
Like what specifically?
Well, back in February 2020, they set up the Sustainability Reporting Standards Board, SRSB, its mission. Raise awareness, implement responsible business measures, develop audit guidance for IR. Very proactive.
Okay, the SRSB.
They also introduced India's first award to celebrate the business practice of integrated reporting, really promoting excellence.
Recognizing good practice.
Yes, and crucially, education. They launched a certificate course on Sustainable Development Goals, SDGs, Business Responsibility Reports, BRR, Integrated Reporting, IR, and proposed an executive development program on Business Responsibility Reporting, BRR.
So, upskilling their members.
Exactly. Ensuring CAs are equipped for these new demands. Plus, they've issued vital publications, real resources for people doing this work. Things like the Standard on Assurance Engagements, SAE 3D0410 for greenhouse gas statements, detailed background material on BRSR, guidance on SDGs, FAQs on sustainability reporting, even a sustainability reporting maturity model, SRMM.
Wow, that's a lot of support material.
It is. Really guiding professionals and companies through the complexities, ensuring quality and consistency.
Okay, so the BRSR is here. It's mandatory for the top 1,000 listed companies. Let's dig into it. What exactly does it entail? What's its structure? How does it organize all this information?
Right, the BRSR, pivotal for Indian companies. As you said, reporting under BRSR is mandatory from financial year 2022-23 for those top 1,000, though voluntary adoption was allowed a year earlier.
Okay. And its purpose?
Core purpose. Provide quantitative and standardized disclosures on ESG parameters. Why? To enable comparability. Across companies, sectors, over time, standardization is absolutely key for investors and others to make informed decisions.
Makes sense. How's it structured?
It's structured into 3 sections, giving a logical flow.
Yeah.
Section A, general disclosures. This is the basic context. Company details: name, products, services, scale of operations, employees, holding subsidiary associate companies. Sets the scene.
The basics.
Section B, management process and disclosures. This dives into the company's approach to sustainability. Its policies, management processes, governance structures related to ESG, leadership commitment, oversight mechanisms. Tells you how they manage it.
Okay,
Section C, principle-wise performance disclosures. This is the real heart of the BRSR. Here, companies report on Key performance indicators, OPIs, in alignment with the 9 principles of the NGRBC, those national guidelines on responsible business conduct.
Right, the 9 principles.
And this section further classifies KPIs into 2 crucial categories. This is important for your exam.
Okay.
Essential indicators. These are the mandatory disclosures, non-negotiable. They cover fundamental data points, training programs, key environmental data like energy use, emissions, water, waste management, leadership indicators. These are optional disclosures. They include more advanced info, maybe life cycle assessments, conflict management policies, more granular data on biodiversity, energy efficiency, supply chain management.
Optional but encouraged.
Exactly. The guidance explicitly says listed entities should endeavor to report the leadership indicators also. It encourages best practice, a higher level of transparency beyond the minimum required.
Okay, let's unpack those 9 principles of the NGRBC then. You said they're the bedrock of BRSR reporting in Section C. Understanding these seems absolutely crucial.
It is. These 9 principles, while distinct, are really interlinked. They reflect that holistic nature of responsible business. Think of them as a corporate code of conduct for sustainability, mapped across E, S, and G.
Right, let's go through them.
Okay. Principle 1, ethics, transparency, and accountability. Mandates businesses conduct and govern themselves with integrity in a manner that is ethical, transparent, and accountable. Core elements: policies embedding ethics, info available to stakeholders, disclosing adverse effects, encouraging the value chain to adopt principles, responding to violations, fundamental integrity.
Got it. Principle 1, integrity.
Principle 2, safe and sustainable goods and services. Businesses must provide goods and services in a manner that is safe and sustainable across their life cycle.
Elements.
Designing products, processes to minimize resource use, educating consumers, consuming sustainably, encouraging reduce, reuse, recycle, the whole product journey.
Principle 2, product life cycle.
Principle 3, promote well-being of all employees, including those in the value chain. Businesses promote the well-being of all their employees and others in the value chain. Key elements: regulatory compliance for employees, respecting dignity, freedom of association, no child forced labor, work-life balance, timely wages, aiming for living wages, safe workplaces, skill development, preventing harassment, prioritizing people.
Principle 3, employee well-being. Crucial.
Principle 4, respect for stakeholders' interests and responsiveness. Businesses must respect the interests of and be responsive to all their stakeholders. Elements: transparent communication on impacts, identifying all stakeholders, fairly sharing benefits or opportunities, recognizing impact beyond shareholders.
Principle 4, stakeholder engagement.
Principle 5, respect and promote human rights. Businesses must respect and promote human rights. This means understanding rights, Constitution, laws, International Bill of Human Rights, integrating them into policies, practices, respecting rights of all stakeholders, especially vulnerable groups, a fundamental obligation.
Principle 5, human rights. Non-negotiable.
Principle 6, protection and restoration of environment. Businesses must respect and make efforts to protect and restore the environment. Elements: policies to assess aftereffect impacts, optimum resource use, measuring performance, pollution, waste, energy, contributing to climate resilience, Paris Agreement, exploring reduce, reuse, recycle, improving environmental performance, stewardship of the planet.
Principle 6, environment. Core E.
Principle 7, influence on public and regulatory policy. When businesses engage in influencing policy, they must do so in a responsible manner. Elements: contributing constructively, using associations responsibly, ensuring advocacy encourages fair competition and prevents rights abuses. Ethical engagement, not just lobbying.
Principle 7, responsible policy influence.
Principle 8, promote inclusive growth and equitable development. Businesses should promote inclusive growth and equitable development. Elements: addressing social, cultural, economic impacts, land acquisition, mitigating adverse impacts, creating products businesses, helping marginalized communities, aligning CSR with local priorities, fair compensation for displacement, respecting traditional knowledge, being a positive force for society.
Principle 8, inclusive growth. Very yes.
Principle 9, provide value to the consumers in a responsible manner. Businesses must provide value to their consumers in a responsible manner. Elements: reduce negative impacts of products, prevent restriction of choice, fair competition, transparent disclosure of adverse impacts, maintain data privacy, inform on safe usage disposal, no misleading advertising, accessible grievance redressal, enable universal access for essential goods, treating customers ethically.
Principle 9, consumer focus. That covers a lot.
It really does map out the expectations comprehensively.
And what's fascinating here is You mentioned this briefly before, but how these detailed Indian principles align directly with those broader global sustainable development goals?
Yes, the mapping is quite clear and deliberate. It's not a coincidence. It shows India's commitment to the global agenda, tailored to its context.
Can you give an example or two of that alignment?
Sure. Principle 1 on ethics and transparency maps directly to SDG 16, peace, justice, and strong institutions. Principle 6 on the environment aligns with a whole cluster of SDGs. 6, clean water. 7, clean energy. 12, responsible consumption. 13, climate action. 14, life below water. 15, life on land.
Oh, yeah.
And Principle 8, promoting inclusive growth, maps to another broad spectrum. SDGs 1, no poverty.
Yep.
2, zero hunger. 5, gender equality. 10, reducing inequalities and others. It demonstrates that strong, consistent commitment across national and international frameworks.
That's really helpful to see the connection. Now, given how crucial BRSR is becoming with these standardized disclosures, how do we ensure the information reported is actually trustworthy, reliable? This brings us to assurance, doesn't it? That critical layer of credibility.
Indeed. Assurance is vital. As BRSR is expected to be, a single means for disclosing sustainability-related information in India and a key document for stakeholders, assurance in this reporting becomes more critical.
Like a financial audit, but for ESG data.
That's a good analogy. An independent ESG audit or assurance engagement is designed to evaluate the environmental and social risks for the company's products, services, operations, etc. It also helps businesses internally look at their supply chain risks, risk management capabilities, and transparency with shareholders. But for external users, that independent evaluation lends credibility and reliability to the reported data.
And are there standards for this assurance in India?
Yes, and this is recent and very significant. The ICAI has issued a landmark standard on Sustainability Assurance Engagements, SSAE, 3000, Assurance Engagements on Sustainability Information.
SSAE 3000.
Okay. This is a groundbreaking umbrella standard covering all sustainability information assurance in India. Its effective dates are phased. It's voluntary for reports ending March 31st, 2023. But it becomes mandatory for assurance reports covering periods ending on or after March 31st, 2024.
Okay, mandatory assurance is coming very soon then.
It is. There's also SSAE 3410, Assurance Engagements on Greenhouse Gas Statements, which specifically deals with assurance on GHG data, a critical part of BRSR.
And how is this assurance actually done? What's the process?
The methodology involves several structured steps. It typically starts with a preliminary review of the report and its parameters. Then, on-site assessment and verification of the data and processes. This leads to submission of findings to management, a review of their responses and clarifications, preparation of the assessment and verification report, and finally, issuance of the formal assessment report or statement. It's a robust process.
Okay, a systematic approach.
And what's fascinating here is, beyond just the overall sustainability reports, the ICAI Sustainability Reporting Standards Board has also recently issued a specific set of social audit standards, SAS 100-1600.
Social audit standards, different from sustainability assurance.
They're related but more specific. These SAS provide guidance for the independent impact assessment engagement of social enterprises. So focusing specifically on organizations whose primary mission is social good and assuring their impact.
Ah, okay. Assuring social impact itself.
Exactly. And the scope is incredibly broad, covering everything from eradicating hunger, promoting healthcare, education, gender equality, to environmental sustainability, disaster management, financial inclusion, even welfare of migrants. It shows a really detailed effort to bring accountability specifically to social impact claims.
That's quite specialized. But thinking more broadly again, it's not just about separate sustainability reports anymore, is it? Auditors of the traditional financial statements also need to consider ESG factors, right? How does something like climate risk factor into a standard financial audit? Investors are certainly focused on it.
That's a crucial and definitely evolving area for auditors. While the primary job remains, getting reasonable assurance about whether the financial statements as a whole are free from material misstatement.
Right, the core audit objective.
Climate-related risks and other ESG factors are increasingly relevant to that objective. When understanding the entity and its environment, the auditor should include the consideration of climate-related risks and how these risks may be relevant to the audits.
Especially in certain industries.
Exactly. It's particularly true in certain sectors or industries. For example, banks and insurance, energy, transportation, materials and buildings, agriculture, food, and forestry products. Industries where climate risks can directly hit asset values, liabilities, future cash flows.
So auditors need to think about potential financial statement impacts.
Precisely. And with users focusing more on climate, auditors might face pressure for transparency in their own reports while still sticking to auditing standards. Sometimes, if climate risks are fundamental to understanding the financials, an emphasis of matter paragraph might be needed to draw attention to specific disclosures.
Okay.
Auditors also need to check if the entity has disclosed relevant climate info appropriately in the financial statements. And importantly, under standards like ISA 720 and SA 720, auditors have to read the other information like the annual report narrative, press releases.
Stuff outside the financials.
Right. To ensure consistency with the financial statements and what the company is saying publicly about things like climate commitments, it forces a more holistic view.
Okay, that makes sense. Now let's try and bring all these concepts together. We've got a rich, integrated case study here designed to really challenge your understanding, just like an exam might. It involves two companies in the agrochemical sector in India.
Right. This looks like a very relevant and complex scenario. Good for testing application.
So the background, the agrochemical sector in India, it's huge, $35 billion. But it has issues. Low awareness among farmers about impacts, pressure to use more chemicals, serious concerns about adverse effects on people, animals, nature.
Toxicity is a big issue.
Exactly. The Central Insecticide Board, CIB, uses color codes. Red is most toxic, then yellow, blue, green. Problem is, many red-labeled products banned elsewhere are still sold in India due to weaker regulation.
Worrying.
Plus, maybe 25% of agrochemicals sold are counterfeit. This damages legitimate companies and means they need authenticity checks like barcodes and multilingual instructions for safety.
Okay, sets the scene. High-risk sector.
Now, the case focuses on two listed companies, A and B. Both are in the top 1,000, so BRSR applies. They make agrochemicals. Company A is proactively complying with ESG. They've decided to eliminate red and yellow labeled products, even though they make money. They're boosting R&D spending to meet new, stricter norms and improving labeling with user-friendly barcodes. This caused an 8% revenue dip initially.
Okay, Company A proactive, taking a hit for long-term compliance.
Company B, however, is purely focused on immediate revenue. 14% of its bestsellers are red and yellow labeled. They're even increasing production of DDT, highly toxic red labeled. Company B saw 9% revenue growth, but it's now under regulatory investigation by the CIB for its non-compliant product.
Company B, short-term focus, high risk, facing investigation. Classic conflict.
Exactly. So let's tackle the questions arising from this scenario. First one. One, what would be the reporting requirements for each of the two companies?
Okay, this one should be straightforward based on what we've discussed. Since both Company A and Company B are among part of top 1,000 listed companies by market cap.
Right, that's the trigger.
They have to mandatorily provide BRSR reporting in accordance with 9 principles of NGBRC as mandated by SEBI. It applies equally to both, regardless of their strategy or performance. The requirement comes from their listing status and size.
Okay, both must file BRSR. Next question. 2, which company has absorbed the impacts of possible future regulatory changes? What are the steps taken by that company for complying with the regulatory standards?
Right. Well, based on the descriptions, it's clearly Company A has absorbed impact of regulatory changes. Their actions show foresight.
What specific steps demonstrate that?
Several key steps. First, it decided to eliminate red-labeled and yellow-labeled products, which are toxic, proactively removing the highest-risk items. Second, it increased expenditure on R&D to meet with new regulatory norms, investing in future-proof solutions. Third, it incurred costs for improving its labeling system, which would help end users, addressing safety, authenticity, and comprehension.
Okay, now the crucial part for an exam, linking these steps to the BRSR principles.
Absolutely. This shows deeper understanding. Principle 2. Safe and sustainable goods and services. Company A meets this through R&D for safer products and by eliminating red-labeled, yellow-labeled products, ensuring goods are provided safely and sustainably.
Makes sense.
Principle 9. Provide value to the consumers in a responsible manner. The friendly, barcoded packaging labeling system adheres to Principle 9 by providing clear, accurate information for safe use. Principle 3. Promote well-being of all employees. Discontinuing toxic chemicals is good for workers' health and safety, aligning with Principle 3's focus on a safe workplace.
Right, worker safety too.
Principle 6. Protection and restoration of environment. By stopping products harmful to the soil, Company A meets Principle 6 requirements related to reducing environmental impact and pollution.
Okay, so Company A's actions clearly align with multiple BRSR principles, showing a strategic, proactive approach.
Exactly. Integrating sustainability into strategy, even with a short-term cost.
Now, third question. 3. What would be the consideration by the auditors of company A and B in the audit of financial statements?
The auditor's view. This would differ significantly between the two.
So for company B, the risky one.
For company B, the auditor's task is much more critical. They'd absolutely have to consider requirements of SA 250, which deals with laws and regulations. Why? Because non-compliance may result in fines, litigation, or other consequences that may have a material effect on the financial statements.
And they are being investigated.
Precisely. The fact that the Central Insecticide Board has already launched its investigation is a huge red flag. It could lead to massive liabilities, penalties, maybe even operational shutdowns. So the auditor also needs to consider SA 570, the going concern standard.
Could this non-compliance threaten their ability to continue operating?
Potentially, yes. If claims arise, which the company may not be able to satisfy, it could cast significant doubt on their going concern status. Big implications for the audit report.
Okay, serious considerations for B's auditor. What about company A's auditor?
For company A, the perspective is different. The auditor can obtain assurance from regulatory compliance by the company. Their proactive stance reduces future regulatory risk.
Even with the revenue dip?
Yes. That fall of revenue by 8% is likely seen as a transitory phase, a short-term cost for long-term compliance and stability, not a fundamental threat. So less concern from a risk perspective compared to B.
But auditors for both need to check compliance.
Absolutely. For both, auditors need to obtain audit evidence regarding compliance with laws and regulations, and audit procedures have to be designed accordingly, understanding that regulatory environment is key.
That case study really brings the principles and the auditor's role to life. Let's tackle one more integrated scenario. Quick Push Finance Limited. It's an NBFC, top 1,000 company, so BRSR is mandatory from FY 2022-23.
Okay, NBFC, BRSR, mandatory. Got it.
They report in sections A, B, C. Section C uses essential and leadership indicators. We know the company has an anti-corruption policy, runs awareness programs for dealers, has mechanisms for e-waste and paper disposal, is a member of industry chambers, gives government input, and promotes inclusive growth via CSR.
All right, the mix of activities touching different principles.
Exactly. Now let's run through some multiple choice questions based on this, applying our BRSR knowledge.
Okay, fire away. Let's see how we apply the principles.
1. Regarding the anti-corruption, anti-bribery policy and the awareness programs for dealers, which is most likely true.
Okay, thinking about policy versus external training. The policy itself is fundamental governance. Principle 1. Training external dealers is more proactive. So I'd say having an anti-corruption, anti-bribery policy is in nature of essential indicators. Organization of awareness programs for dealers is in nature of leadership indicators. The policy is mandatory, essential. The external training is voluntary best practice leadership.
Makes sense. Okay, 2. Regarding the mechanisms for recycling hazardous e-waste and disposing paper waste, which NGBRC principle are involved.
Waste management. It touches on sustainable production and environmental protection. Principle 2 covers sustainable goods services, including production methods like waste handling. And Principle 6 is squarely about environmental protection and waste management. So it has to be D, Principles 2 and 6. Both apply.
Got it. 3. Considering membership of industry chamber trade associations and providing inputs to governance, which NGBRC principle is referred to.
Influencing policy, using associations. That sounds very specific. That's Principle 7, isn't it? Influencing public and regulatory policy responsibly. So D, Principle 7.
Correct. 4. Which activity relates to the principle that businesses should promote inclusive growth and equitable development?
Inclusive growth. Principle 8. That's about helping marginalized communities, aligning CSR with local needs. The options mention CSR projects in aspirational districts. That fits perfectly. So A, CSR projects undertaken by the company in designated aspirational districts of country.
Exactly. And finally, 5. Which statement is true regarding essential and leadership indicators in BRSR reporting?
This is a fundamental distinction we discussed. Essential are mandatory, leadership are voluntary but encouraged. So the answer must be B. Essential indicators require mandatory disclosure, whereas leadership indicators require voluntary disclosure. That's the core difference.
Perfect. That really tests the application of the BRSR structure and principles. So reflecting on everything we've covered, what does this all mean? It's been a huge journey today.
It has.
We started with the fundamental definition of sustainable development, dug into the specific, granular elements of the ESG pillars.
Mm-hmm.
We navigated the global framework's GRI, the move towards harmonization with the ISSB. And of course, we did a really deep dive into India's own detailed BRSR principles, linking them back to the global SDGs.
Right, and the 6 capitals of integrated reporting, providing that holistic view of value.
Yes, and how crucial independent assurance is becoming to lend credibility to all this reporting.
Absolutely. And most importantly, hopefully for you listening, we've applied these concepts directly through those integrated case studies, those exam-style questions.
Breaking down how to analyze them.
Exactly. Breaking down how to think about them in practical scenarios. This deep dive should genuinely arm you with the comprehensive understanding, the specific terminology you need. Not just to excel in your exam, but really to understand the fundamental shifts happening in sustainable business today.
Definitely. And as reporting of sustainability information becomes this global norm, the demand for independent assurance, well, it's just going to grow dramatically, isn't it?
It has to. Entities worldwide need to enhance the integrity, the trustworthiness of their sustainability reporting.
Which raises a final important question for all of us to think about. How might this ongoing global pursuit for a common language in sustainability reporting like the ISSB is aiming for, how might that fundamentally reshape not just how businesses operate, but how we as a whole society actually measure what true value creation really means in the years to come? It feels like it could be quite transformative.
That's a profound thought to end on. It really could redefine value. For everyone listening, keep exploring, keep asking questions. Remember that knowledge is most valuable when it's truly understood and, crucially, applied. Good luck with your preparations.